Hi there. We're back talking about the sales and accounts receivable cycles and auditing them. So the last video we talked about your client's process for a sale, what accounts we might have to audit, and we talked about the audit risk model. Remember that we want to keep audit risk very, very low. Therefore, we have to understand inherent risk at the client. We have to test the client's controls to make sure the client is controlling for this inherent risk. Then you and I, as auditors, once we understand this risk of material misstatement, we can adjust our detection risk. We can do tests that have a different nature, a different extent, or different timing to make our audit risk very low, or have a little more audit risk if we feel like risk of material misstatement is low. We can have a little more audit risk. That's less expensive for everyone. All right. So first thing we have to do, of course, is understand inherent risks at the client. All right. So the main number one risk in this cycle is that your client is going to recognize revenue that they didn't really earn. All right, so there's a lot of ways to do that, and we're going to have to make sure we understand how this particular client might have a revenue misstatement. Certainly errors can happen, but revenue is one of the more risky areas because that is the main area your client wants to overstate, right? So obviously some accounts people want to overstate, some accounts people want to understate. Revenue is one they want to overstate. So what might they do? Well, for improper revenue recognition, a big inherent risk is they're going to try to claim that they have more revenue in the period under audit than they really have. So a couple ways to do that is just with cutoff. Cutoff is the ending date, right? So when an auditor says cutoff, they're talking about the financial statement date, right? So December 31st. So what some people do is hold that cutoff open, right? They'll recognize sales from, say, the beginning of January as a sale. They won't close the books. They'll have a sale order that came in at the end of December. They haven't really shipped it, so it's not a sale, right? But they'll count it as a sale because, hey, we got the order, we know we're going to ship it, but technically not a sale till they deliver the good or service. So they mess with cutoff in different ways. They do a bill and hold. So, hey, we're having a big sale, end of month sale. Why don't you take advantage of our big sale and buy a whole bunch of our product, right? And we'll ship it for you when you need it. Again, yes, it's a sale. Yes, it's going to happen. Yes, maybe they've even been paid for it. But that's not a sale. That's a liability, right? That would be unearned revenue. And another way is channel stuffing. Excuse me. Just shipping a bunch of stuff that maybe you know is going to be returned. But you have shipped it. That's what this channel stuffing is. You've shoved it out to your distribution channels. That's why they call it channel stuffing. So you've shoved it out there to those channels, and it's not really a sale because you're not really going to get paid for it. They're going to say, oh, we don't want this. We're going to return it. So those are some of the bigger inherent risks related to revenue in this cycle. Of course, there are also risks with returns and allowances. These allowances are contra accounts, right? So if you want your accounts receivable and asset to be overstated, you'll take a smaller allowance, right? Things like that. And of course, collectability of receivables, huge risk. If they're not checking credit, if they're just selling to anybody, like we want to get our sales revenue way up, maybe they won't check credit, or maybe you just have a salesperson who wants to collect commissions, so they have sales and they don't care about the credit. So according to revenue recognition rules, there has to be a likelihood you're going to get paid for that sale. So you can make a sale, legitimately deliver the product, But if you know you're not going to get paid for that, right, that's still not a sale. That can't be revenue. Plus, obviously, if you know you're going to get paid for it, you're probably overstating your accounts receivable too. So these are the big material inherent risks in the cycle. There are a lot of smaller risks, but the material ones are improper revenue recognition, returns and allowances. Because those are estimated accounts, there's always risk with an estimate, right? And collectability of receivables. Here you've got this idea that there's a third party out there that's going to give your client some money. How likely is that? How well did they check that credit? So these are your bigger inherent risks. All right. So as you know, as we do our audit work, right, we are testing management's assertions, right? It's not just the account balance that we test. We are testing for all the proper assertions. Now, some have more relevance than others for different types of accounts, right? So people aren't going to purpose, usually, it'd be pretty weird, but they aren't going to understate revenues, right? So completeness, yes, it's an assertion. Yes, we need to test for it, but it's certainly not as important as occurrence for revenues. So the relevant assertions in this cycle for revenue are occurrence, completeness, and cutoff. The relevant assertions for accounts receivable are existence, completeness, and valuation, right? So when we look at inherent risks, we're looking for inherent risk to occurrence, right? So in other words, did this sale that created this revenue, did this sale really occur, all right? And is it an actual sale for the company? It's not some kind of operational fraud or some organizational fraud committed by an employee, something like that. Completeness. So did everything we sell get into the books, right? So completeness, again, not as big an issue with revenue. Cutoff, is it in the right period? And this can be fraud or it can be legitimate error. You know, if you get a sale order and it comes in, it could be the accounting system doesn't realize something's on back order, so they just go ahead and stick it in the journal, post it to the ledger as a sale, whereas really it's not going to be shipped for a month, right? So cutoff is a problem with revenue. So this is what we're going to look for controls, right? So these are inherent risks, and we're going to look for controls. For accounts receivable, so revenue is based on a bunch of transactions, right? A sales occurs or it doesn't. Accounts receivable is an asset. So that asset either exists or it doesn't. See, that's that distinction between occurrence and existence. So with accounts receivable, the inherent risk is it doesn't exist, right? So if the revenues were fake, they didn't really occur, then they probably made a fake account receivable to go with it. So that would mean that it's on the books, but it doesn't exist in the real world. So that's an inherent risk with accounts receivable, is existence. Or just it's not really related to the company that you're auditing. Completeness tends to not be as big an issue for receivables as existence, because it's just not very likely you'll leave off an asset. Could happen, but not as likely. And then of course there's valuation. Is that number the right number? All right, so here's some inherent risk, right? And let's talk about the inherent risk to revenue. So here's the deal. You've probably learned in intermediate that revenue must be realized or realizable and earned. All right? So that means either you've been paid the cash for that revenue, right? You made a sale and you got the cash, or you really will get the cash. So in other words, if it's not likely you will be paid for that sale, it's not realizable. So it must be realized or realizable in order to be revenue. You can't just say, well, I did ship the product, but they didn't pay me for it. That's still revenue. No, if it's not realizable, it's not revenue. And of course, earned. So that means you had to perform the service, deliver the good. The work on the client's end had to have been done. So for your client to be able to recognize revenue and put it down on the income statement as sales revenue, needs to be realized, realizable, and earned. SEC says, auditor, you'll need to be able to find actual evidence and arrangement exists, right? So some things are contracts. I'm going to ship you this in the future. Imagine you're Boeing building a jet, how long that takes, right? So there has to be something that shows this is actually a sale. Delivery has to be occurred, services rendered. The price is fixed or determinable, and you're going to collect it. So the same idea, realized or realizable and earned. So the SEC does provide some guidance. So now as the auditor, right, you're trying to understand the inherent risk, right? So now you know, okay, what accounts are in this cycle? What are the most relevant assertions? So what can go wrong with these assertions? Well, so for occurrence, management may overstate them by just making up some fake sales. This has happened a lot, right? I mean, really, all you have to do is go in the accounting system and type in some sales, right? So that could happen. Another thing about revenues and whether or not they've occurred is, remember, it has to be realized or realizable, so they may not recognize that there are going to be returns. All right, so for a sale to occur, it has to happen and you earn it, right? So if somebody returns it like you were channel stuffing, that's not a sale. Completeness, not all sales recorded. Like I said, that's not a big inherent risk in this cycle, but it could happen through error. I don't think anybody's going to intentionally have an incomplete sales revenue account, but it could happen through error. And of course, cutoff, that's a bigger risk. Sales are in the incorrect period. What people tend to do is want to move sales forward, right? So at the end of the month, they're not meeting their sales goal, but they know that next month somebody's going to make a big purchase, so they'll get that contract, and it's not shipped, it's not paid for, but they're going to put it down as a sale for the current period, knowing that it'll happen in the next period, it'll be fine, that accrual will reverse, it'll all be fine. All right. What can go wrong in the collection part of the cycle with your accounts receivable? Well, for existence, right? Especially if you've made up a fake sale, you probably made up a fake account receivable too. So accounts receivable may not exist. That's a risk. That's a real inherent risk that they don't exist. They're not amounts owed from sales. The assertion of completeness, again, not as applicable for an asset. Most people want to get all the assets on the books that they can. But obviously, through an error, some account receivable could be left off, so we do have to make sure there are controls in place for that. And valuation. The receivables aren't at the right amount on the financial statement. So there need to be controls in place that make sure they're taking the right value for receivables, right? So typically on a balance sheet, you'll see that receivables are net receivables, and that's net of the allowance for bad debt, right? Doubtful accounts, whatever they call it, that client. So your client should be estimating their bad debt expense, right? And taking the bad debt expense and setting up an allowance for write-offs. So that's an estimate. And for a very large corporation client with a lot of accounts receivable, right? Imagine you're auditing Procter & Gamble. Well, I'm pretty sure that Walmart and Target, HEB, they don't pay cash when they order trainloads of Tide. They have an account receivable, and every so often they pay it to Procter & Gamble. So if you're auditing Procter & Gamble, Procter & Gamble's going to have some accounts that don't get paid, right? And so they need to have that allowance set up. And imagine something as material as accounts receivable at Procter & Gamble, millions and millions of dollars, right? So a 1% or 2% difference in the allowance is millions of dollars, right? So because it's an estimate, it's easy to go, oh, I think it's only 1%. It's not really going to be 2%. So it's easy for them to kind of understate that allowance. And if you understate the allowance, now you're overstating accounts receivable. So your valuation is wrong. So sorry, we should have been on that screen. So anyway, so that's what can go wrong in revenues. You can have something wrong with occurrence, completeness, or cutoff with accounts receivable. You can have existence, completeness, and valuation errors, or fraud. And it does actually happen, right? So there's a lot of bad guys, and this is not a complete list, sadly. There are a lot of fraud that goes on. This is probably your more typical financial statement fraud, all right, is revenue recognition, because it's so easy to slide things from one period to the next, and it can be difficult to catch. So look out for revenue recognition inherent risks. When we come back on our next video, we'll start talking about the control risks, right? So we know we understand the inherent risks. That's what this is about. We keep our audit risk low by understanding the inherent risks so that we can go on and test the control risks. So now that we understand what the inherent risks are, we can go look and see what controls our clients have in place for those inherent risks, and we can test those. So when we come back in the next video, we're going to talk about control risk in the revenue and collection cycle, and we'll talk about testing for control risks.